I think it would be useful as a starting point to say something briefly about SGA's investment philosophy and geographical focus, if you could, Rob.
SGA builds concentrated global portfolios of the most predictable and reliable businesses, our definition of quality, that can compound revenue, earnings, and most importantly, cash flows in the double digits over time. Typically over a 3 to 5 year investment time horizon at a faster rate than the indices. We build the portfolios based on current opportunity. So we take advantage of volatility that provides us with the best combination of that quality or predictability, growth, secular growth, and valuation. And that allows us to deliver good absolute returns in pretty much any environment, and good relative returns, particularly in times when global growth is slowing or when the environment is more uncertain, which happens to be the environment we think we're headed into.
So how does that focus on reliability, growth and valuation mean that the portfolio fits in to the Willis Towers Watson stable of managers?
We believe we're a good complement to more momentum-oriented growth strategies where valuation may be less of a discipline. And we believe we can protect capital when multiples, perhaps, of those more momentum-oriented businesses might contract and ours don't. We believe we're also a good complement to more value-oriented approaches, which may gravitate towards more cyclical businesses and slower growth businesses, because our approach incorporates more predictable compounding and long-term compounding of earnings and cash flows.
And how did the portfolio perform last year, both absolutely and relative to its benchmark index, given that 2021 was a pretty good year for markets overall?
In 2021, the portfolio generated a return somewhere between 8 and 9%, a decent absolute return, but not as strong a return as the overall market, which was close to 20%. The market was driven primarily by the rebound in the economy off the post-pandemic or the pandemic low. So earnings for the index were up over 50%. Those are typically periods when cyclicals rebound, when we tend to underperform. And if you dig deeper and look at what sectors did well in 2021, they were energy, financials, and technology, especially in the semiconductor area. Those are areas which are typically, actually notoriously unpredictable over time, not the predictable, sustainable businesses that we look for. The good news is, as we look forward to this year, 2022, and ahead, we're now lapping those very strong periods of growth. We're likely to see a normalization of global growth back to the mid or even low single digits. In fact, we may see a deceleration off of what was the prior normalized growth rate as a result of the events in Europe and higher inflation.
Perhaps you could say a bit more about that normalization. Looking back over recent months, how has the rotation away from growth-oriented companies that thrive in low interest rate environments and towards value-focused businesses, how has that affected the portfolio's performance?
So the market's rewarding of more cyclically sensitive companies that are rebounding from the pandemic low has been difficult for our relative performance. Again, absolute performance has been okay. The significant earnings growth posted off of the pandemic lows has created a lot of momentum in certain areas. And again, the opportunity from here is that's created a valuation opportunity in more sustainable growth companies that we've taken advantage of. And as earnings decelerate in 2022, we expect that to happen, particularly in the second half of 2022, and particularly now with the pressures on growth as a result of higher inflation and the events in Ukraine.
And what about the investment opportunities it's thrown up? Have you, for example, been increasing exposure to attractively priced digital companies?
Yes, absolutely. Weakness in the more predictable and sustainable growth areas of the market have created opportunities for us. While periods of relative underperformance, which we've experienced over the past year or so, are unpleasant, they're the natural outcome of a focused and disciplined investment approach, and we've seen this before. It allows us, the volatility that provides, allows us to upgrade the portfolio, both in terms of the quality and the growth, and we can do so typically at better valuations given the volatility that markets provide.
Could you maybe give me an example of where you've been able to upgrade in that way?
We added Intuit, a SaaS software company providing financial and tax preparation software that grows at a fast rate on a global basis. We've added a very predictable business in Danaher, which has 75% captive recurring revenue consumables. And we've added Recruit, a Japanese business which has a very promising future, especially in its job search engine.
Turning back to macroeconomics, SGA are very much longer-term investors with a focus on quality and growth and sustainable returns. Given that rampant inflation and potentially stagflation are very much in the headlines at the moment, how are the companies in your portfolio likely to be impacted by rising prices and possible supply constraints?
The first key business quality criteria that we look for in our approach is pricing power. The ability of a company to price its product at good margins, regardless of what's going on in the environment, regardless of what their competitive set might be doing. Particularly, that's important for environments like we're experiencing today. It also provides a lot of predictability to businesses over time, which eventually will face some period of price pressure. We're also very careful in terms of what we pay for cash flows in the future in our discounted cash flow model. One pressure that we're experiencing from higher inflation is higher discount rates on the valuation of businesses, and we're seeing that in markets today. We've been very careful about that, evaluating our discount rates over the past year, and therefore think we're valuing companies appropriately regardless of higher inflation rates. And then finally, if you think about it, probably the best investment you can make, or the best hedge against higher inflation, is investing in businesses that have real growth, real secular growth beyond the level of inflation.
Your investment approach means that the companies that you hold tend to hold up well in inflationary times then. So following on from that, capital preservation becomes a much bigger issue for investors in these kind of conditions. In regard to resilience in the face of inflation, are there particular characteristics that you look for when you're assessing companies?
So in addition to pricing power, we look for businesses that have recurring revenues, revenues that repeat regardless of what's going on in the environment, and have long secular tailwinds to their growth, and that the growth may come from the opportunity in a growing end market, or the opportunity may come from the ability to take share in an existing market.
Do you have an example in mind?
Danaher is a good example of a business that has those characteristics, which we added in the first quarter. They have 75% of their revenues coming from a recurring reagent stream, which they sell into a captive scientific instrument base. So through thick and thin, the owners of that equipment have to buy their reagents. And because those markets, their end markets, are driven by life sciences or healthcare, there's secular tailwinds behind that growth. So you can expect that their business will grow through any economic environment, and will do so predictably and at a high rate. The combination of pricing power, which we talked about earlier, and recurring revenues and the secular forces behind growth provide a predictability to earnings and cash flow growth, which we believe protects capital in a period of time of uncertainty and lower economic growth. And the numbers bear that out. If you look at the risk measures behind our approach, we protect capital better during difficult times.
The other big issue in regard to uncertainty at the moment is the war in Ukraine, of course. So to what extent, if at all, is the portfolio taking account of this development and its likely longer-term implications for macroeconomic considerations? For example, fuel supplies being restricted.
Our portfolios have no direct exposure to the Ukraine, Russia, Belarus, and in fact, all of Eastern Europe represents only 2% or less of the revenues of the portfolio. So the indirect effects are likely to be minimal. We did, however, convene our team and we engaged in what we call a all-hands-on-deck drill to reevaluate our view of the environment.
So what do you anticipate will be the main implications for investors, and how do you expect the portfolio to fare?
We do believe that the events in Europe will cause a higher level or more prolonged high level of inflation, and will also cause a deceleration, a more dramatic deceleration of growth off the pandemic bounce of last year. We've adjusted our numbers accordingly. We've even been conservative in our assumptions, assuming that this will lead to a European recession. Regardless of that, we anticipate that our portfolio companies and our portfolio in aggregate will deliver double-digit earnings and cash flow growth over the next year and the next 3 years, far superior to the indices. There is perhaps a more profound implication of what has happened, perhaps an acceleration of an existing trend which we had identified, and that's a reversal of the globalization trend we've seen over the past 30 years. That's been very productive in terms of global growth and efficiency. It's now running in reverse. And perhaps the emergence of another Cold War will, and particularly what's going on in energy markets, will be a catalyst for a faster reshoring, or as someone put it, slowbalization, a reversal of globalization.
ESG investing and climate change have really been pushed out of the headlines recently by more immediate concerns. So how far do you think that they are being set back by current events? Does it have any implications for your stock selection process?
Our investment approach has naturally been ESG since the start, since we named the firm Sustainable Growth Advisors over 20 years ago. And we incorporated elements of ESG into our process. We believe then, as we do now, that companies must act in a responsible fashion with respect to all their constituents in order to have a sustainable future. So the fact that ESG is temporarily out of the headlines does not change our approach. The market's current preference for more cyclical, less ESG-friendly businesses that are seeing their earnings rebound off of pandemic lows is likely to be short-lived. In the energy sector, obviously, there are other factors at work, but again, we think this recent events may actually accelerate the movement towards a less carbon-intensive future.
Have you introduced any new initiatives to try and keep on top of decarbonisation in the SGA portfolio?
Most recently, what we've been doing on the ESG front is trying to precisely calculate, or precisely as possible calculate, the carbon intensity of the businesses within our portfolios. So we can actually carbon adjust for instance, a carbon tax, carbon adjust earnings. It's difficult. One has to get at not just scope 1, but scope 2 and 3 impacts. and not many companies have done those calculations yet, and they have not necessarily been verified by standards bodies. So this is work in progress, but that's our goal.
More generally, are there any particular parts of the world or investment sectors where you're finding plentiful opportunities at the moment?
We're focused on identifying companies that meet our criteria for quality and growth, and we don't necessarily invest thematically, looking at sectors or a particular theme at any point in time. That said, market volatility gives us opportunities, for instance, today in perhaps faster growing businesses as valuations have collapsed.
What sort of opportunities? Could you give me an example?
So, for instance, we added recently Mercado Libre to the portfolio. Mercado Libre is the largest and most dominant e-commerce platform in Central and South America. They're currently growing their e-commerce business at about 50% and their payments business at about 100%. However, the stock price has fallen from about $2,000 a share to $1,000 a share over the past year, a 50% contraction. So there we saw a valuation opportunity in faster growth as investors seem to be moving away from growth companies given higher interest rates. We've done our valuation work and we believe this is an opportunity, and we're building in nice secular growth over the next 3 to 5 year period with Mercado Libre.
Finally, I wonder if you could tell me about a wildcard stock you own, if you can think of one, by which I mean a stock that is a bit left field or unconventional or not terribly well known, but is nonetheless potentially pretty rewarding.
So I think maybe the company Recruit falls in this category of a wild card. It's a company you may not have heard of, but they're the largest classified advertiser and staffing business in Japan. Historically, this was a set of pretty mundane businesses that operate in a pretty slow growth environment in Japan. And you can imagine they could also be quite cyclical. But over the past 10 years, they embarked on a strategy to broaden their digital relationship with their small business customers and be more global in their recruiting business. They now have an exciting SaaS, or software as a service business, with their small business customers in Japan. And they operate the largest global job search engine, Indeed, which is growing over 50%. In the next 3 years, these businesses will grow to be the majority of the company, making it a much more predictable and higher quality business, as well as a faster growing enterprise. So while you've not heard of Recruit, I'm sure you've heard of Indeed, and you may hear a lot more about Recruit in the future.
Thanks very much for taking the time to talk to us today, Rob.